How's it going, everybody? Thank you for being here. My name's Antonio, and you're about to watch or listen to a conversation that is general and impersonal in nature, one that will not include any financial advice, nor other professional advice of any sort, but it will likely include a lot of forward-looking statements and possibly speculations about future events. So be warned. Pause the screen right now as well. You have a larger warning on your screen right now, just to be safe before continuing. And that all said, I am talking to someone very special here today, Lynette Zang of ITM Trading. Ma'am, thank you so much for investing your time with me.
I'm really happy to be here, Antonio. Thank you for having me.
Oh, the pleasure is all mine. Obviously, it's been a while since we last spoke, and we live in interesting times. So I really am looking forward
Yeah.
to this conversation. But before that, I'm also looking forward to learning more about how you've been. How's the off-grid house? How are the chickens, the fish, the garden, the daughters? How's everybody? Everybody happy and healthy?
Everybody is happy and healthy. And I think part of what helps them be happy and healthy is they know that I'm doing all of the work on the bug out location, which I think since the last time we spoke, I put in a completely new and much larger solar grid. And we've begun to construct our hothouses. We had a little snag, but we're working through the snags. And the hothouses are about feeding 40 people.
Okay.
So I'm anxious to get those up, and we're recording all of that. But yeah, just moving forward, because without one little doubt in my mind, I know where we are in this fiat government debt-based currencies life cycle, and we're at the end, period. And it should be pretty clear. I mean, look at how much has changed since the last time we spoke, with the crisis of confidence in England and what's happening in Credit Suisse. But, really, I would say the biggest change is the confidence levels in the central banks have gone down pretty dramatically. So I
Mhm.
feel they're super fragile.
We're actually already sort of going into what I normally like asking, sort of my first question to the interviews, which is around getting to know my guests' holistic view of the world, like geopolitics, markets, currencies, and so on and so forth. So, if we were to get in a helicopter right now, went inside your head and look at how you see the world from a 50,000 foot view, what would we see?
Well, Antonio, you'd see a lot of history because I was born in 1954, and I've been groomed for this moment of time. And I've been a banker. I too studied business finance, which is all about Keynesian economics, which is not real economics, in my very strong opinion. I was a stockbroker and there on Black Monday in 1987. I was there in 1971. So, but in 1987, I started studying currencies, and therefore I started seeing repeatable patterns, and I could see a currency life cycle. So if you were looking in my head, there are patterns that I'm seeing right now that happen 100% of the time during currency regime shifts. And that means that the currency that we know at the current debt-based system is going away to be replaced by a new system, which, if the central bankers have their way, will be central bank digital currency, which is programmable money.
Hmm.
So, and then I'm seeing some really things that I don't like seeing when I'm looking at those CBDCs. I just recently dug into two reports from the Federal Reserve on the central bank digital currencies. And one thing that really stood out for me is, the whole purpose of having money was to enable a society to specialize. And therefore, money had to have four key functions and attributes. It needed to be a tool of measure, a tool of barter, a way to make sure that you were fairly paid for your labor,
Mhm.
and a long-term store of value so that whenever you use that money, you were fairly paid for your
Mhm.
labor. Gold does that. right? It has all of the attributes. One of the things that was so alarming to me is that, and I can't even tell you when they did it because I couldn't figure it out, but the first thing they did was remove the long-term store of value. Well, gosh, we all know with inflation, if you hold pieces of paper or digital currencies in your account, they're going to lose value over time by design through inflation. But what was so I didn't like seeing that, but it's more honest anyway. But what was very disturbing to me that I just recently saw is that they are reducing the functions of money down to 2, from 4 to 3, and with the advent of the CBDCs to 2, which is simply as a tool of measure and a tool of barter. No longer will you be fairly paid for your labor, because once we're in a completely digital system, as soon as you get paid for your labor and it hits the account, well, gosh, those accounts will most likely be negative rates. So whatever you got paid will instantly start losing value. So forget even being fairly paid. Now, who's that okay with? Yeah, I mean, to me, that is so important for people to understand the 4 functions of money and how central banks are taking away those functions. It scares me, to be honest with you.
Yeah, well, I get that, and I'm also not, I'm obviously not surprised that you're mentioning gold here, of course. And Lynette, you and I spoke for the first time, I believe, was in 2021, early 2021, and must have been January or February or something along those lines. And you sort of told me your thesis about how the currency, how we are sort of in the fourth turning, if you will, of the currency because of too much money printing and stuff like that, and why we should be buying gold. But it's hard to stay sort of loyal to that thesis, at least for me, because of what's been happening in the meanwhile. The dollar has actually stayed rather strong if you measure it against other fiat currencies. And
voila. If
right.
you measure it against other fiat currencies, but inflation and global inflation, so I don't care where you are in the world, should show you the truth, because it doesn't matter how many of these things you have. It matters what you can convert them into. Food, energy, everything. So the fallacy of a strong dollar is that it's not real. And it's really actually not just a thesis. The reason why we have to shift from one current currency regime to the next current currency regime is because there's virtually officially no purchasing power left in the currencies. That's also one reason why we're seeing more rapid inflation. And interest rates have been anchored at 0. That's the key tool to regulate the rate and speed of inflation. And it's been anchored there since 2008. So now they're trying to raise the rates so that they can lower them into the next crisis that they're creating. And what are they going to do? Are they just going to keep printing money? And then that makes everything okay? Because it doesn't. It loses every time a central banker prints that money. The money that's already in existence loses value. So, and the other part of it, Antonio, and hey, I could be wrong, but if something has happened the same way over 4,800 times, and it's happening again, let's see, are we going to get a different result? No, we're not. The most likely outcome, I suppose we could, that's not something within my control, but if something's happened the same way 4,800 times, we're doing the same thing. The most likely outcome is we're going to get the same result.
When I'm a relatively small investor, so my net worth is definitely nothing special. I'm not an accredited investor, for example. So what I would pay attention to is the chart of gold, which is measured in the dollar. And when you see that pair since, the dollar to gold exchange ratio, if you want to call it. People call it the gold price. You could call it whatever you want. When you see it since 2021, you see it going down, and then it went down, and then it's been chopping sideways ever since then. And it's sort of frustrating, especially if you have, like, for example, I'm speculating on the price of gold by being in gold mining stocks. And when you see that, it's kind of frustrating. So that's why I said it's sort of hard to stay loyal to the precious metals while that's happening. Do you think there's a fault in my mindset or in the way that I look at it, or how do you see it?
Yes, and both. And the reason is because what you're looking, here's a few things. Number one, a rising gold price is an indication of a failing currency. Central banks, governments do not want you to know that that currency is failing, right? That's number one. Number two, what you're referring to is the spot gold market, which is simply a contract that, there are different sizes of contracts, but here in the US, $145 controls 500 ounces of physical gold. So a lot of leverage is used. And actually, before they changed with netting and compression and all these garbage accounting tricks, I went in, and the Bank for International Settlements, which is the central banker's central bank, tracks global derivatives. Before they changed the accounting tool, I saw it with my own eyes. 62,000 ounces of derivative gold, which is gold that does not nor ever will exist, for every 1 ounce of physical gold. So if magically there were an extra 62,000, 62 trillion thousand, who knows really how many of these contracts are out there? Could that suppress the visible price that you see? Of course. At the same time, have you noticed the ginormous premium that buyers of gold in China are paying? Higher than any crisis since 2017, which is as far back as I could get that chart. Okay. So and also in the lower collectible physical gold market, as well as the higher physical gold market, and just the regular kind of more bullion market, there are tremendous premiums that are being paid for the physical while the spot price is dropping. I saw the same exact thing happen in 2008. The spot price was dropping like crazy, but the physical market was making new all-time highs then. Okay. So yeah, you're looking and trusting that what Wall Street is telling you something is worth, and you're believing it, which is exactly the intent, right? Because every single thing in the market is now been turned into a financial product. Real estate, do you flip real estate on a day-to-day basis? Do you check the price of it on a day-to-day basis? No, you have a house and you live in it, right? But that's been turned into that kind of product, as has gold, everything has. It's the whole financialization of the world. It's been turned into a big derivative, which is just a leveraged bet based upon the price action of the underlying stock or bond or weather or credit or what have you. They can make derivatives out of everything. So I think that where most people go amiss is that and I don't get this, but why do you trust the stock markets to tell you the truth? There's no good price discovery, and especially there hasn't been good price discovery since QE started in 2009. There's no good price discovery.
Well, what's the alternative? If you don't trust the market to sort of show you the price, what's the alternative?
Understand history and also understand how to determine what the true value, that true fundamental value of any asset or any instrument is. Because that's really the only way for you to know, is something overvalued, fairly valued or undervalued. Therefore, do I want to buy it? Do I want to hold it? Do I want to liquidate it? But people get caught up in the euphoria. So with gold, which actually is a pretty simple method, right? And you don't have to get to the penny. We're just trying to get you close, right? Gold is good money. It's been good money for 6,000 years. The stuff that they create, whether it's digital or printed, okay, this is the flip side of the same coin, right? So how do you know what gold is really worth if you can't look at Wall Street or the spot market and go, oh, gold is worth this, okay? Well, how is this created? This is created by creating debt. So you take all the debt that's been created. On the other flip side of that, there's a finite amount of anything physical. So there's a finite amount of gold, whether it's in the ground or it's above ground, because gold is indestructible. So we can account for like 98% of all the gold that's ever been mined. And the Department of the Interior does a global sweep every year on how much gold is still in the ground. But there's a finite amount. So you take all the debt and you divide it by all the gold, and then that tells you roughly the true fundamental value of an ounce of gold, which is somewhere at the moment, somewhere north of $15,000. Okay, now, here's the thing. Until the central banks are actually ready to regain your confidence. So first, there's going to be an absolute loss of all confidence, and we will go into, a hyperinflationary depression. That's what I think lies in I think it's already started, actually. Then, once all confidence in the central bankers and the current government regime has gone, we'll be in hyperinflation. When they are ready to get it back, then they revalue, they take this, which has no intrinsic value at all, and they revalue it against that. And that is when we will see gold go somewhere near and probably surpass its fundamental value in terms of, in this country, dollars, but they could be in terms of euros, in terms of yen, whatever the fiat currency is, because they're all debt-based, they're all government-backed, right? So you can look at Venezuela, and they've now done 3 overnight resets. And globally, that's on average how many overnight resets happen in a currency. I guess it's because people want to believe when they come up with something new that that's going to save them because they're in so much distress. But I don't know how many they're going to ultimately do in Venezuela, but I can tell you that the first one, and it's gone up since then, but the first one was something like 3,500 times overnight because the currency was devalued like 99.5%. So that is when you will see the true fundamental value. So don't get disheartened. Just know that what you're accumulating is a severely undervalued asset. And Wall Street is not the one that's going to tell you what the fundamental value is. That will be the government and the central banks when they do their first overnight reset and probably their second, lopping off zeros, et cetera, as we've seen in Zimbabwe and many other countries. So it's been quite easy for me because I've been studying it since 1987, and there is not one tiny doubt in my mind because there's so much historic information on how this happens. And yeah, it'll be a little teeny different because we're in different technology today than we were 100 years ago, but you'll see the same kind of patterns around it. Look at all the volatility. Look at what's happening with war. There's always typically some kind of women's movement and some kind of social movement that's going on. So there are all of these things that you always see 100% of the time during currency regime shifts, and I'm seeing all of them.
Is it does that also maybe have, well, that's maybe a different topic. Even though I sort of refuse to believe it by looking at you, you just told me that you've lived through many of the financial crises and you were a broker
Mhm.
during some of those too. So,
Yep,
um, you know, you kept your finger on the pulse of the economy back then as well. I'm assuming
yep.
you seem that kind of lady. So, what does the current moment look like the most in your opinion? Is it the GFC? Is it 1929, Weimar Germany, the energy crisis of the 70s? There's so many stuff that I could talk about. So is it, I mean, what
I
do you
would
think?
say that it's probably most like the Industrial Revolution, because we are evolving into a completely new space. When you look at 1929, that was the kickoff of the system. 1971 was an evolution of the system, because everything was pegged. When I look at where we are right now, because there is nothing in there to support the current monetary regime, it has to go into something else. And what they're looking at are those CBDCs, which, I mean, just think about the evolution of money, right? When the population used gold and silver as real money, if you did not like what the government was doing, you simply took one of these, went into the bank and converted it into one of these. And then that took gold out of the system and created restrictions around what the government could do, how much debt they could grow, et cetera. So this is how you voted. You removed the gold from the system because you didn't trust the politicians.
Hmm.
Well, no politician likes that. So they took that ability away from the public in 1933. In 1948, and I'll tell you why this is so important to understand. In 1948, or 44 rather, in Bretton Woods, the world came to an agreement that if the US would keep an ounce of gold valued at $35 an ounce, then the whole world would peg their currency to the US dollar. And what that actually means is tie the currency to the dollar. So the dollar then was as good as gold because it was supposed to be backed by gold, $35 an ounce. But then the US got involved in the Vietnam War and they needed more money. And this is also something that always happens. When you go into war, it really justifies inflating the currency.
Mm.
So the US did not live up to the bargain, and they actually reneged on it. But in the 60s, so many countries were sending in dollars to pull out the gold that we had less gold in our coffers. There was actually a run on the dollar in the 60s. And so, excuse me, President Nixon really, I don't know that he had no other option, but they say close that gold window, meaning he disallowed governments from converting their dollars into gold. So
Yeah.
that was taken away, right? So now the citizens can't vote. All right. But if you're sitting with dollars or euros or whatever, you have the cash where you have it, well, we can't go to before we go to negative rates, your cash would preserve your principal, not your purchasing power. Inflation was in the currency by design, but it would at least protect your purchasing power or your principal. Well, what's really happened, because there's no purchasing power left in the currency and the interest rates, their biggest tool, has been anchored near zero, and they've tested negative rates. So the public will not just accept the negative rates. Well, then they had to come out with a way to attack your principal, right? They've attacked your purchasing power since the day you were born. They were selling this lie to you and we believed it. But now what they're looking at is programmable money. For this, it would take roughly 18 months. The central bank creates a policy and then they distribute it through the commercial banks to the public. 18 months to know whether or not their policy was effective. We go into CBDCs And this is what they're talking about. People need to really understand it. For the government, hey, they can do lifetime taxes. Whatever you earn gets deposited in today. Boy, they can do daily tax withdrawals if they want. You have zero control. So for the government, it's all about taxability. But for central bankers, well, they even say it. These are not my words. These are central bankers' words. We can just adjust the policy as needed instantly and constantly. So that means that, number one, and they say this is not my words, these are theirs. Once we go digital, there are no limitations to how low we can push negative rates. And negative rates attack your principal. Mm-hmm. So that goes back to the functions of money. My paycheck gets deposited in my account and immediately it loses value. Not even through inflation, but rather through deflation. Mm-hmm. And the way that they say they're going to sell this to us is we go to CBDCs, there will be no inflation because we're going to control everything. Yeah, there's going to be heavy deflation, which is why I say now I was saying this before, but it's more true now. Now I understand how they're doing this because of their words. We will be in a hyper deflationary stage, because during hyperinflation, what happens? People recognize how quickly this is losing value, so they rush out to convert it into anything that they can so that it holds more value. Well, if you make a deposit and you see your principal going down, 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 you're just going to let it go to zero? No, you're going to go out and you're going to buy anything that you can that may hold its value better. So this is what I'm talking about. And this is what's coming to fruition. And this is what's different than when we talk. Plus, we're a lot closer to the LiBOR transition, which is, I don't think they can do it. I could be wrong, but I don't think they could do it.
I think it was last week or maybe 2 weeks ago that I watched an interview with I guess one of your favorite persons in life. It was someone from the IMF. I can't remember who, but I know you love all of them. But
I do.
he said that their number one priority goal right now is to fight inflation, and that nobody should be pivoting here before that.
Yeah.
Are they going to be successful in doing that over the short term, or at least is CPI going to appear as if it's dropping, or do you expect a pivot sooner rather than later?
I expect a pivot later rather than sooner, because the problem that you're talking about occurred, maybe 5 or 6 months ago, where the central banks had been promising let me back up to move forward. Mm-hmm. Since 2008, global central banks gave themselves a new tool, which is called forward guidance. I mean, they had forward guidance, but now they really started using it, right? So they would tell the markets what they were going to do and give them a long enough period of time to get into position to take advantage of it, right? Forward guidance. And that's been going on heavily since 2008. So the Fed kept coming out and saying a half a basis point or 50 basis points, 50 basis points, 50 basis points. That's how much they were going to raise rates. Mm-hmm. But then at the last second, without warning, they raised them 75 basis points. Now, that may not seem like that big a deal, but what that did is huge, because it undermined the Wall Street, the markets' ability to count on the central bankers doing what they say they're going to do, something that they've trained them into since 2008, right? This is so huge. So then what happened, and what's happening right now, and why the central banks are making that statement, we're going to keep going, doesn't matter what, we're just going to keep raising rates, is because what they're trying to do is get their credibility back. And I did a video on that at that time, and I knew that they were going to, push us into a bigger crisis because they're trying to get their credibility back. And we see a huge credibility crisis over at the Bank of England, which is, an advanced economy. It's kind of a big deal that that's actually happening. So they also admit that the kind of inflation, which really, of course, they did not create any inflation by doing that. Yeah. Goodness gracious, no. But the kind of inflation that is being caused by war and by supply chain bottlenecks and things like that, well, goodness, they can't really do anything about that inflation. The only inflation they can work on is demand inflation. So they need higher unemployment. They need actually people to stop buying stuff. And frankly, it's been working.
Like houses, right? I mean, mortgages, what is it? The US well over 7%. Even here, I think my father-in-law's mortgage is locked in at like 0.5% in Europe, so which is free money almost. But right now, if you get 4%, you should be happy. So that's quite a lot more than that, even though it's better than the US. But what is this going to go to? 10% mortgage rates? What do you think, by the way, about that? Because it, like you said, it's been working. People are going to be buying. Some people are now saying that they are not able to afford the house they live in if it goes to 7%, which also might mean that people are overspending, though, because if you can't afford a house at 7%, you probably weren't able to afford it at 5% either. But so,
what do you think? Is that the prices are a whole lot higher. And I'll tell you, when I first got married and bought my first house, which would have been, I got married in 77. I think we bought our first house in 78, I think, something like that. And the interest that I paid on it was 12%.
Wow.
Right. So
but the house was like $15,000.
The house was actually $59,000.
Okay.
And right now that would probably be, it was 1,800 square feet, 3-bedroom, 2-bathroom, so it was not a fancy schmancy house. It was a starter house, but it was a nice house.
Maybe like $500,000 easy.
Probably.
Depending on the location, of course, but I'm just assuming, yeah.
Right. But is it because that house is worth that much more money? No, it's because the dollar is worth that much less. And that nominal confusion that inflation creates, where people get married to the number, right? It throws you off. You don't realize that what's actually happening is you're working for less and less money. So going back to the question, the central banks, both here, Christine Lagarde admitted it, Jay Powell admitted it, that they don't understand inflation. And yet these are the guys that are battling it. And if you look on a global basis to, like, say, Mexico, for an example, they've raised their rates a lot more than we have in the US. And that has not impacted their inflation rate. Their inflation is still climbing at an unexpected rate. And every time you see a headline, they never expect the rate to be as high as it is. Shocker. They should have me on. I tell them, yeah. But so no, the only, it's not going to work because it's a different kind of dynamic. And the difference in that dynamic is where we are in the currency's life cycle. Now we are at the end, period. There is not one little doubt. Then they take us into CBDCs, that's programmable money. They could tell you how much they'll deposit it in there. They'll give it to you for nothing to get you to use it. But they can tell you where you can spend it, how long it's good for. The negative rates will erode the principal. If they don't like you, like they tested in Canada, they just push a button and boop, you're cut off, which is why it's so important to have money outside of the system. But Yeah, no,
Yeah.
that's really what's happening. So them talking about fighting inflation is garbage. They
Hmm.
created this mess. They know that they have to transition. It doesn't work anymore. They don't have any of the tools anymore. And so, yeah, I mean, it is that simple.
Hmm. Hmm. I remember first time, it must have been one of the first times I went out to eat with my then girlfriend, now wife. I was ordering something and I asked, this is gonna make sense in a second, but I asked the staff if there was meat in what I was ordering, and they said yes there is. And so, but my girlfriend was like, "Oh, you don't eat meat?" And I was like, "No, I don't eat anything without meat." And I have this worry. I mean, this just to show you that I really enjoy eating meat, and I avoid eating anything that doesn't have meat in it, just for the nutrient value of it. Anyways, I have this worry that eventually this might result in that type of social credit stuff, like, oh, you're only allowed to buy these meats and not buy this. And there's these synthetic foods also that are being pushed in your sort of in your face when you walk into the grocery store. And I have a feeling that if we ever do go to that, and this is a gut feeling, just a wild guess, but I have that feeling that eventually it's going to go down to, okay, you can use this money as much as you want from it, but you're only able to buy, let's say, a pound of beef a month or something like that. Um,
I
that's
agree.
what I'm, worried about in the back of my head, I guess, a little bit. So,
Well, I agree. And up in my bug out location, we still have to finish refurbishing the barn, right? So we do have goats up there for mitigation, and we're going to get more goats, but we're getting breeding, milk producing, we're getting cows. So we'll produce our own meat. So we're putting in a full farm, but we're doing mating couples. So say, or not couples, but maybe 3 females to 1 male
yeah,
for
that's
all of
yeah.
these different, whether they're rabbits, we've got rabbits up there so far, and chickens up there so far, and goats. That's what and dogs. Those are the animals that we have up there. But we have plans. Like we know the farm that we're going to get the meat cows from. We know the farm. I want Normandy cows because
Okay.
Normandy produces the best cream, ice cream, yogurt, butter. I mean, that's like tippy top in my opinion.
Hmm.
So there's a farm in Wisconsin that breeds them. So
Hmm.
yeah, for the same thing. I don't want anybody telling me what I can or cannot do. But I do think you need things that have lots of vegetables too, though. You
Yeah,
can't
no,
eat just
I
meat.
do
And
enjoy
that's what the
vegetables.
hot houses
I
are
just don't
about.
want anybody to, tell me eat this processed meat that has like 50 ingredients in it, and my beef's got one ingredient, which is beef. So, um, yeah, that aside, I want to go back sort of to the housing market because that's obviously
Yeah,
a huge part of the economy. Wouldn't it, if that came
totally.
crumbling down, people are not able to
It
afford it,
is.
foreclosures, stuff like that.
Hmm.
Wouldn't the Fed step in such a case though, or do you think that do you think they'll be around to bail out the financial institutions and not the citizens? I mean,
I
can they
think
do
the
anything? I don't know.
days, right. I think the days of really bailing out, it'll look like it because they'll turn around and, print more money. But, they created this housing market bubble, and this is globally. And I think in Belgium, I mean, the advantage that we have in the US in many ways is we have 30-year fixed mortgages. But do your mortgages reset every so often, every 5 years or 3 years or something like that?
So that's the thing. We have 25 is the max that you can go for. They don't like it. And if you go for it, your rates are very much higher if it's a fixed thing. And otherwise, it's you have 3, 5, and tens. So it's a fixed for 3 years, and then every 3 years they get to revisit and do it. I think that most people that do it right now are pushed towards doing 3 or at least a 5 year thing. So.
Right. So where are interest rates going to be in 3 years and 5 years? Who really knows? I think what's going to push the Federal Reserve to pivot is the problem that we're having with liquidity in the treasury bond market, not the real estate market.
Hmm.
because the treasury bonds are the global foundation of all of the markets. And so, I mean, we started having liquidity issues around the treasury market in 2015 with the flash crash. And I think we've had 2 more incidences, but now you even have Treasury Secretary Janet Yellen coming out and saying that the Treasury is considering buying back what they're called off the run. So treasuries that are already in the marketplace, which although there was recently an auction and the on the run, so the new treasuries that they were issuing were less liquid than the off the run and the already issued treasuries. And that usually is flip-flopped. So for the Treasury to sit there and say, we're going to go in and buy our bonds, or we're thinking about going in and buying our bonds, that's huge. I mean, that's the foundation of the global market. If that freezes, that means everything freezes. Everything. That is so much bigger than just the real estate market or the stock market or the corporate bond market. We're talking about the treasury market, which impacts every single market on the planet. Everything. That's when they will pivot. When it seems like they're going to wait until they fully break it. Because
when does that happen? I mean, what are the rates? Because the rates are pretty high right now, and the higher they go, the harder it becomes for financial institutions to remain solvent. I'm guessing. So
correct.
I mean, how high do they go? Are we going to see, in the 70s they had at least in Belgium we had like 10-15% bonds even. So is that something we're going to see?
Yeah, that's why I had a 12% mortgage.
Yeah.
And I remember I had a 5-year CD at 15%. It would not surprise me to see it that high and then higher, but not because the central bank has pushed it to that level. I mean, I have this one graph. It's called, it's a $ and then TYVIX, which is the Treasury Bond Volatility and Index, which that particular one, they stopped publishing. Don't hold me to this because I have to go back and look, but I think maybe 2018 or 19. But the reason why I love that, and if you want it, Megs, we'll just write down, I'll send you this chart so you can see it. And anybody, you can share with whoever you want. But you can actually watch the evolution of when the Treasury bond was stable. And so what you see on the graph is just straight lines, a bunch of little dashes. And that means, and what that meant was that the price volatility just on a Treasury bond just didn't move very much, right? It was in like a super narrow, teeny weeny range, which is what you want for a foundation. You don't want a foundation that's moving like crazy. You want a solid foundation. When 2008 hit, what used to be like dashes went to like this. So we started seeing more volatility in the Treasury market. But in 2013, you can see it. That was when the traders took control of the Treasury market. So instead of doing this, now it started doing that. And now it's doing like this. If it were an EKG, you would go, oh my God, this patient is having a heart attack. So the problem is, again, going back to the financialization and how everything has been turned into a financial product that can be traded on a global basis. And traders do not care if they're going to undermine the entire global system. They only care about picking up that little bit of money, just like central banks don't seem to care if they are undermining absolutely every market in the world. For gold, it's obvious suppression because they don't want you to understand what we're sitting here talking about today, because then you make different choices. Then you just keep stacking. You don't care about the price. I don't care about the price. Goes up, goes down, goes sideways. I just keep buying. with every bit of extra fiat. I don't buy stocks. I don't buy bonds. I don't buy annuities. I don't buy any of that garbage because it's irrelevant. When that stuff you can only convert into this. So when this loses all value, what do you got? You got nothing. But this is used in every single sector of the global economy. So is silver, right? Gold and silver used in electronics, in medicine, in the financial system, in art, in food, in every area. So you have the broadest base of buyer, but what we're seeing in the treasury market is that buyer base shrinking. That's not good. Globally, a lot of global central banks are selling off their treasury holdings, right? And the entities that used to step up to buy, like the big commercial banks and the pension plans, as well as the foreign central banks, they're not in the market anymore. You go into a fight. What do you want? You want one thing that's like, here's my sword. Okay, this isn't going to hit anybody. Or do you want, and it has the most narrow base of buyer, right? It's used in one area, one. Or do you want something that is used and has the broadest base of buyer? So yeah, depending upon what's going on, if it's a true supply demand market, sometimes the price is going to go up, sometimes it's going to go down, but it never goes to zero. But you look at the currencies, and the EU particularly has some huge challenges right now with keeping the EU together versus fragmentation, which is a big issue because they're all pegged together. No pegs ever last. And that's what I'm seeing a lot too, is that the currency pegs are breaking down. They're starting to break down. And so, yeah, it's so fragile. The whole system is. I'm glad I have my bug out location. And I will feel a whole lot better once I get those hot houses done.
Things that are forced generally don't last forever. They say nothing lasts forever. Some things can, I guess, but things that are forced, they definitely don't last forever. A lot of these unions are forced instead of formed. I kind of laugh about it because it's almost a similar word, but it's also true. You know what happened in the global financial crisis 2008? What happened then is people waking up to the fact that the safe investments that they were in were not as safe. And there was a thesis, I believe it was Joseph Wong, Fed guy, who made the thesis that this time around those assets are not mortgage-backed securities. The new MBS are bonds. Because after global financial crisis, financial institutions were sort of forced to have those on the balance sheet because they don't have the same counterparty risk as other stuff do, but they still have the risk. They still have volatility. They're as volatile as a junior minor, as you pointed out, or even worse. So what happens when the system sort of realizes that those are not as safe as they used to be, and they start selling those out? Then the yields, go spiking up. Stuff that are based on the 10-year yield, what's that? Mortgage rates. What happens? Foreclosures, and then the dominoes start falling. Is that something you would also see happening?
100%, 100%. And you're absolutely right. Anything that's forced, like the peg system, currency pegged to another, it never lasts. History shows that. 100% of, I don't know, call me crazy, but if something happens 100% of the time, and we're doing the same thing, I just think we're going to end up with the same kind of result. And globally, housing is a huge part of the economy. In China, I think it's like 70%. In the US, it's 30%. I think it's 30% in the EU as well, isn't it?
I'm not sure.
Yeah, but that's a huge percentage. And they created these housing bubbles, and now they're popping these housing bubbles. Well, it's not going to go away easy. And it's going to be very hard for most people. So yeah, do they want you to buy gold and silver? Heck no. Because once you have it out of the system, It truly is invisible, and I control it. And if you look, the Bank for International Settlements did a piece on what share for gold in reserves, referring to currency reserves. And they said, you talk about counterparty risk. Gold is the only asset, financial asset, the only one that runs zero counterparty risk. Because a big chunk of what you are actually referring to are leverage buyouts, and the leverage levels in the system, in other words, debt upon debt upon debt upon debt, they're approaching the same levels that they were in 2006. So no, they're not safe, and things are off the balance sheet. So they're hiding. It's like an iceberg. You see this teeny weeny piece, but the real danger is hidden. And there's, I could be wrong about this, but in my opinion, the real danger is in the derivatives, which is just a bet, a leveraged bet based upon the price action of the underlying.
But if they were able to bail out the financial institutions that took too much risk in 2008, aren't they going to be able to? I mean, look at what's happening with the Bank of England. What happened with the Bank of England? They had to bail out those traders who took on too much, risk because, why worry about it? When you fall, they're going to catch you. Aren't they going to bail out the financial institutions that struggle with bonds this time? I mean, aren't they going to be? Wouldn't they have to support and buy up bonds and start QE and?
Sure. And I agree, except that we're at a much higher level in our balance sheet. I mean, in 2008, where the Fed's balance sheet stood at about 800 billion. Now it stands at just shy of 9 trillion?
9 trillion, yeah.
That's a big difference, right? So can they do it? Of course they can. Doesn't cost anything except for purchasing power and confidence to print a whole bunch of money. And that's exactly what they're going to do because they don't have any other tools. But the question is, will that actually bail them out this time? No, there's a whole lot less purchasing power in these currencies. But here's the key. There's also a whole lot less confidence in the public that the public has. And that's really the problem in the rising inflation and the rapid inflation is people notice that. If they can keep it at 2%, they're getting what they want, right? Which is the loss of purchasing power, which is an invisible tax. But you don't notice it so much. You go to the grocery store and this costs 8 euros. You go to the grocery store, now it costs 8.01 euros. Do you notice that? No, you don't. But you go to the grocery store and what you paid last week for 8 euros, it's 9 euros. Maybe you'll notice, maybe you won't until you go the next week and it's 10 euros. And all of a sudden you're like, what's going on here? So that erodes confidence. And the confidence has been eroding since 2008, especially. You can see it in different surveys that they do. Consumer confidence in the US, I don't know what it is in the EU right now, but in the US, it's at the lowest level ever.
Yeah.
Ever. And this is a con game. So con games require confidence. So that's the big difference between 2008 was when the system died and was put on life support. There's no more life support left. It's done. They've used up everything. They've used it up.
What's also interesting is that you have the energy crisis. There is a food supply shortage problem like that are causing inflation. So a lot more people need support. More jobless people, I guess, or not necessarily jobless in the way that we can see it, because it came down to something like people work more jobs, but they get paid less and stuff like that. So they generally need more supports. Some governments are even issuing tax cuts and stuff like that. How do they finance that? Bonds.
Voila.
So how do they finance that? Is bonds. But if you have, the Fed or other central banks not doing QE, not buying up bonds, that can get that can get out of hand pretty quickly. It can run into a disaster, I guess, is how I'm seeing it. And
Exactly.
I guess it's a matter of when, not if, but that when seems important to me. Like, it seems to me as if there is an opportunity in that window in between. So when is that when does this come to an end? Like, when does all that, the house of cards, when does it come falling?
I believe really, really strongly that we have this shift in the benchmark interest rate, the LIBOR, that the whole world used and put in all of those contracts. In this country, it goes to the SOFR, but I think by you, it's going to the SONIA or something else. I think there's like 5 key benchmarks that have been created. The transition from, at least in this country, from the LIBOR to the SOFR, as the deadline is, I believe it's June 30th, June 1st, but no, I think it's June 30th of 2023. At that point, the 600 trillion of derivative and other financial contracts that are currently tied to the LIBOR, for those that have not yet made that transition, they have to transition into in this country, the SOFR. So I think that before that, in fact, I can't prove this, so this is just my opinion, but I think I've been saying since January 1st of this year that this is a pivotal year because of that transition next year. They ran a test of it in 2000, I think it was 19, with 80 trillion, and it went dead silent for like 3 weeks. And it was originally supposed to take place in 2021. And then after that 3 weeks, then they magically postponed it to 2023. This is a big fat experiment. And according to the Bank for International Settlements, there's 600 trillion in notional value derivative contracts that have to make this transition. And that may not seem like that big of a deal, except that when they run the numbers, the interest rate for the LIBOR is different than the interest rate for the SOFR. And my bet is this is true for all of those benchmark rates. So they do this plus an adjustment, and it still doesn't get them to this exactly. So that means that every single contract that has to transition from LIBOR to SOFR or whatever the other benchmark is, the market value of those contracts changes. It changes. It may not seem like a huge, ginormous change, but you're looking at 600 trillion notional. And when you hear somebody say notional, what I automatically know is nobody knows the real value. Nominal, notional, that just means you really don't know the real value that's at risk. So when you ask me when, I think that there's got to be a major crisis before that transition, because I don't think they can do it. And I don't think they can really do it. They'll try, but and then who's going to bail that out? I mean, it's probably, if I'm being realistic, the level of contracts that really have to transition are probably in the quadrillions, not the trillions, because that's just the current market value of those contracts. So, I mean, I'm not Megan, am I taking my time getting the bug out location ready? No. And I'm preparing it for 40 people because it takes a village. A community is like a really important thing. I can't do it all myself, right? So, yeah, I need lots of talents and stuff. I'm rushing as fast as I can to get this ready because that's how close I think this is.
What do you think the main issue is with LIBOR? I hear it being mentioned mostly in a negative connotation, and I guess I generally understand it, but I don't feel too confident on what I understand. What do you think is the main issue with LIBOR in general?
Well, first of all, just a teeny bit of history. LIBOR was created by just a handful of big banks in the 80s. And so then all of the contracts, credit cards, mortgages, that too is tied to the 10-year treasury, but all of these contracts reference the LIBOR in them, okay? But it is a stated rate. So every morning, these banks, just this handful of banks get together and they say, well, if I were going to borrow money overnight, this is what I would be willing to pay. And if I were going to loan you money overnight, this is what you would have to pay. So it was never a market-based rate. It was a stated rate.
Who is there to control that that's fair or honest? Who checked that?
Yeah, exactly the point. Exactly the point. Right? They're just the six main, I'm pretty sure it's just six of the main key global banks that determine that.
What, they just made it up?
Correct.
How does that work?
I know, it's hard to believe. They meet every morning and they say just what I said. If I were going to borrow money overnight, this is what I'd be willing to pay. If I were going to loan you money overnight, this is how much I'd want to charge you. And so that was the rate. And what they discovered in 2008, because during a crisis, it's kind of like if the tide is going out, you see all the garbage on the bottom of the ocean, right? And so it was discovered that, shockingly, traders were actually using the LIBOR to trade for their benefit and against their clients. Somehow that got leaked. That was a problem. Otherwise, we would never make this transition because it was too lucrative for the banks and the banksters, as people call it. So in 2012, the Bank of England, when that was leaked to the public, and how many but a few of us nerds paid attention to it, right? But that was enough. Once it was leaked that this was a stated rate and that the banks, that the traders were using it for their benefit against their clients' benefit, so they were manipulating the LIBOR, then they had to come up with a new rate. So that's when that race started, was 2012. And so that's why it has to shift.
Okay. But so the shift from SOFR to LIBOR is sort of going from
LIBOR to SOFR.
LIBOR to SOFR, yeah, right. It's sort of going from a made up rate to like a market rate, or how am I?
That's a great question, because that's what they want you to think. They want you to think that these new rates are all market based, but when you read the fine print, there are a whole bunch of bonds that are eliminated from being part of this bond pool from which they get a real rate. So a big part of the problem is that the new benchmark rates that some key central bankers have created don't respond during a crisis or a turmoil. I can speak specifically for the SOFR. They don't respond the same way during a crisis that LIBOR works. And so that's why the market has had a hard time adopting it, because it doesn't work the same, right? And it throws them all off because this is what they're used to, the LIBOR, right? So they were having a heck of a time getting adoption, but then they forced, to your point earlier, right? They forced adoption from the January 1st of this year. But there's still all those other contracts that are based on the LIBOR. Now, they have changed laws. They have done a whole bunch of stuff to create safe harbors so that consumers can't sue, right? Because what that means is, okay, you've got your mortgage payment, right? Or your mortgage balance, rather. And you open up your statement and all of a sudden you owe a whole lot more money on that house than you thought you did, simply because the internal rate against which your mortgage was valued has changed. Same thing with your credit card, same thing with your car loans, same thing with any debt that you have. The public is going to notice. So if you read in their documentation, I just did this last week, I think, or something like that. It's hard for me to tell because I produce so much content. But and I'm constantly reading this stuff. But they put in safe harbor so that you can't create any class action suits against your mortgage holders or your lenders on any of these capacity. No, it's just too bad, so sad. How do you think that people are going to respond to that?
Hmm. Hmm.
So that's why I think if you want to date, that's the drop dead deadline. And I really do think a lot of what we're experiencing this year is because of what's scheduled to happen next year. Could they postpone it again? That's usually the next question that people ask me. Well, I suppose they can do anything they want, but they now have all of these contracts that have to be written in it. So I don't know the answer to that, but I do know that $80 trillion test was a big fat fail. And so they just use that time, I think, because this is a very opaque, it's very opaque. So you have to dig and dig and dig, and you have to define and define and define so that you actually can grasp how complex and complicated this whole transition is. It's a big fat experiment, and they haven't been right about anything. So I'm pretty sure they're not going to be right about this.
What needs to happen for us to come out of this? Is the system fixable? Does it all have to burn down to the ground? I mean, it seems like everything is just too entangled, and it just almost nothing makes sense. So how do you fix something that is like, it's like, you come, a kid comes home with a broken bicycle, and it wants you to make a car out of the broken bicycle. How do you do that?
You don't. You go out and you build a car. And that's why the whole system has to reset. And I started talking about the reset in 2009 because 100% I knew the system died in 2008. So you can't fix it. That's why they want to transition us from the paper-based system that we're in right now that started in the 70s to a digital-based system, because the current system cannot be fixed. Cannot.
Well, I might be repeating myself, but like, because you're mentioning that you sort of started talking about a reset of the system in 2009, there has been a lot of paper wealth made in the meanwhile, and that, a lot of people made a lot of money, basically, is what it comes down to. So
yes,
what if this takes another 10 years? There's going to be opportunities to come out more, wealthier, because you're building a bug out house, which is great, but you have to have money to do that. And if you're starting from nowhere and you don't take advantage maybe of some of these trends, you're maybe not going to be able to do that.
Well, I would say that's true, but my mantra, can it take another 10 years? No flipping way. Look at the fragility in these markets. So I will put my technical neck on the line here and tell you, no way on God's green earth can we stay in this limbo land for the next 10 years. The system is far, far, far too fragile. But, my mantra is food, water, energy security, barterability, wealth preservation, community, and shelter. Because these are all the things that we need to sustain a standard of living. And so one of the things that I encourage everybody so strongly to do is to become as independent and self-sufficient inside of community. Community could arguably be the single most important piece in here, because it's like the community that I'm building up there. Okay, I am very fortunate in that I have the ability, and I have this money, which I don't keep in this money very long. I either convert it to gold, silver, or what I need for a bug out to take care of my family. But how do you eat an elephant? One bite at a time. So you look at all of those things and you say, okay, where do I feel the most vulnerable? This is how I've done it over the years. Where do I feel the most vulnerable? And I remember when I bought this property in the back door, it was like, now this is not old to you, but to Arizona, it's very old. My house was built in 1929. So somebody could just walk up and go boom on these two French doors that I have and they'd be in the house. I just felt really vulnerable. So the first thing that I did, aside from getting my gold and silver, which is your monetary foundation, but I put in a security door where I felt most vulnerable. Then I said, okay, I know food is the biggest issue for most people during these transitions. And I'm not a gardener. That is not my thing. But I mean, now I know a lot about it.
Mm.
But at that time, I knew nothing. But I wanted to make sure that I had enough food for my children and my siblings. So I started learning how to garden, and that's the way you do it. You say, okay, you go to the grocery store and maybe you buy an extra bag, a large bag of rice and maybe some canned tomatoes, you buy some sprouting seeds that you throw in your freezer. You buy some long storage food, but you look at that mantra and you say, where do I feel the most vulnerable? Now, if you can find a like-minded community, then you don't have to be able to have everything. You just have to bring to the table what you have, which might even just be your talent, right? Because in a village, like I have mechanics, I have carpenters, I have farmers, I have doctors, I have teachers. So, I have bakers, so people that can cook, right? So, because one person can't do it all. I mean, it's just not possible. So community is arguably the most important piece because now you have people that can come together with different talents and also different resources so that you can survive this. And when we look at different places where hyperinflation has occurred, things get very local, right? And let's see, what country? I can't remember the country, but you could buy anything with potatoes, right? Seriously, during hyperinflation.
Yeah.
So
I guess a lot of your Western European countries had that. Belgium's kitchen is based on potatoes a lot. Like we do mashed potatoes, baked potatoes, fries, obviously. So yeah, to your point, but go ahead.
And yeah, so potatoes were a money. It was a tool of barter, and barter is growing. You look at different places around the world, and we do have the internet now. So like in Venezuela, people will put up, maybe they have baby clothes that they don't need anymore, but they need, a winter jacket for whatever, right? So there's a lot when you go through a hyperinflationary depression that we're headed into, anything physical is barterable, but so is any talent that you have. So that's how you tackle it. You can't do it all, but you don't have to do it all. You just have to be inside of a community that all of the parts come together as a stronger whole. That's why I'm on your show, to be honest with you, because it's part of the community building.
So in conclusion, also touch grass, go outside and learn a skill and involve in the community. I guess it's not bad advice.
No, it's good advice. But you do want a foundation of real money because this is a money issue, right? So if you stay in the fiat and understand, because you made a really good point, and I didn't address that before, it's how much money all of these people have made between 2008 and 2022. That's the way they always get you to not just come into the system, because you can look at the cryptocurrencies and the NSA white paper, the government agency white paper on how to create a mint, really outlined the cryptocurrencies. Bitcoin came out in January of 2009. Quantitative easing started in March of 2009, and they want to take us into a digital system. So they have to get us used to it. And one way that they get you used to it is they got to get it really visible so that people see. So you saw the price action in the cryptocurrencies, right? Well, a recent study, 16% of the US adult public has bought cryptocurrencies. Well, that's enough for adoption. That's enough for adoption. So although there was a recent EU paper that came out saying that it was going to be hard to get people to participate, and it's been tested in, China, and a number of countries have come out in South America with cryptocurrencies. And so they found it to be more challenging. But, how do you get people to stay in the system? You make them perceive that they're making money, right? Even though it took all of this money printing, all of this devaluation. I mean, here's my very favorite chart, my very favorite one, if I had to pick one. Go to the FRED, which is the Federal Reserve Education Department, FRED. And in the search bar, you put in purchasing power of the consumer dollar.
Yeah. It's
And
a famous chart, right? Starting in 1913.
Correct. Okay, because that's the real trend, is the loss of the purchasing power. So it may make you feel like you're rich, but in reality, if all you can do is convert that into this, that only has any value as long as there's confidence in it. It's an illusion. It's a fabricated illusion.
I was talking to Jeff Snyder. He does a lot of good research as well, and he told me that we've been in a depression for the last 15 years. And then that QE has been trying to combat that, but by changing the world through COVID, wars, and other stuff, supply chain issues, those things are starting to change and might become a mess. But I had a hard time believing that at first. I was like, what do you mean we've been in depression? I mean, I feel richer than my grandma. And so he started giving me these, points, and sort of proving to me how that's the thing. And it opened my mind. I might feel richer, but what has really changed in maybe the camera of the iPhone has changed or something along those lines. But like my grandma maybe went from not having, that's not necessarily true, but her mom didn't really have running water, went to like that's remote villages in Bulgaria and some places, but so that's where my grandma was born.
Oh,
so
that's where that was the country. That was the country that there was a huge article on their hyperinflation and how you could buy anything with a potato.
Yeah, well, you could. Yeah, that's a different story too. My mom and dad, by the way, survived the hyperinflation in 1997 by selling their wedding rings, which were gold. That's sort of how they paid rent. Yeah, I was 2 years old at the time. But so the point is that sort of my grandma went from almost not having running water to having the internet, which is, a leap. And then from there on, we went from having, a phone with a camera in your pocket to a phone with a camera that's just a little bit better. But not much really has changed.
You've got a whole computer on there, right?
Yeah. Yeah.
You can hold all your wealth right on this little phone.
Yeah.
You can hold all your equity right on this little phone and spend it right from this phone. So all of a sudden, you have spent all your equity and you have nothing. And that's where the World Economic Forum says you will have nothing and be happy. Well, guess what? Wealth never disappears. It just shifts location. And Jeff is absolutely right, because here, real simple, there is only one way to fight deflation, depression, and that is with inflation. And there is only one way to fight inflation, and that is with deflation. So he is right, and that battle has been going on. And why in the 70s, Paul Volcker, who was the central bank chair back then, raised interest rates intraday up to 21.5% and gave the world ramp room to fight that deflation. That's what they've been battling. That's why they got to always have inflation, so they can rob you. It's an invisible tax. but it's also they got to fight the deflation that they caused by all this money printing.
Hmm.
Or the money printing is to fight the deflation that are caused by the interest rates going down.
Mm-hmm.
So yeah, he's right.
Yeah. The legend of Paul Volcker is another good topic. I think Jeff also made a video on that. Uh, Potentially for another time. I'm already taking more time than what you gave me,
Yes.
Lynette, today. So I'm sorry for that. I want to be respectful of your time. I'm going to let you go here. Is there something that you came here hoping to talk about, but I failed to bring up?
Boy, we covered so many things. So
Yeah.
I'm gonna say, I mean, I guess what I really want to leave people with, because I know this conversation was very, very complicated and we talked about a lot of things, but trust your instincts, not Wall Street, right? If things are costing you more, it's not because they're worth that much more money. It's because this is worth that much less.
Mm.
And if you don't lay in physical gold, physical silver, while, thank you very much, central banks suppress the prices, then what do you have to work with? I'm so glad your grandparents had their gold rings. I've heard so many stories of people that have used the gold to get through either wars, crisis, hyperinflation, etc. Real money. That's what this is. Real money. It performs all four functions. Don't let them take the functions away from you.
Mm.
That scared the crap out of me, I have to tell you. And I've
Mm.
been in these markets a long time.
Yeah. Yeah. It was much more recent than my grandparents. It was my parents who had to sell their gold rings. So and
Oh,
some place, yeah, it was 97, right? So yeah, it happened not too long ago. I don't
exactly.
imagine, yeah, I don't imagine that anybody who's watching doesn't know where to find more about you, but if somebody wants to maybe, I don't know, just stumbled on you for the first time throughout this video, they can go to itmtrading.com or to your YouTube channel. Is there another place that you can find you, or is that sufficient?
No, actually, we did start recently. We started another YouTube channel as well and website. It's called Beyond Gold and Silver, where I talk about the rest of the mantra. And our goal in that is to build a really huge library so that we can meet you wherever you are. You said, how do people get started? Well, if you've never even thought about it, you can start there. If you are seasoned and you really know what you're doing, well, there's stuff for you there, and come help us teach other people that are just beginning this journey, because this is not the time to procrastinate. This is not the time to dilly-dally. And what's the worst thing that happens if you buy gold and silver? You have physical gold and silver in your possession. Booty, hooty, Rudy, Manooty.
Hmm.
In other words, it's not such a bad thing. But yes, that's how they can find me. And yeah, I'm all over the place. You can just search my name, Lynette Zang, and I'm pretty sure I'll come up.
Sure, sure. Beyond Gold and Silver, is that a nod to Beyond Good and Evil from Nietzsche?
It could be. I
Okay.
think that's a
Yeah.
good idea. I don't, we just, on the ITM channel, that's where we really talk about all the economic things and the gold and the silver. On the Beyond Gold and Silver channel, that's where where I get to talk about the farming and what's going on, and how to build. We're going to be building rammed earth house, and doing all sorts of stuff up at the bug out location to help people get prepared. But at ITM, we use those recognizable patterns. I mean, it's not rocket science. It's just if something has happened over and over and over again, put yourself in the best position. You think you feel rich now? Wait till you see that go up 3,500 times overnight.
Mm.
And you can pay off any debt that you have, like that fixed rate debt. And you're in a position for when the real estate bubble, when it's somewhere near a bottom, you take the gains from your gold and you convert it into your income producing assets. That's when you'll actually really be wealthy.
Mm.
So this is what we do at ITM. We help
Yeah.
you plan.
Well, you can peg that to Nietzsche and his will to power and stuff like that. But
I
I'll
love
let that
that.
to you. Yeah. Yeah.
Thank you.
All right, Lynette, I'm gonna shut up now. Otherwise, we're gonna be here for days. Thank you so much
I
for being
know.
here today, and have a great day.
My pleasure. Thank you.
Bye.